Hello, everyone. Thank you for being here, and I'm very honored to be here. My name is Henry Elder. As Andrew mentioned, I am the co-founder of Digital Asset Advisors and the president of the International Blockchain Real Estate Association. And as part of Digital Asset Advisors, we tokenized one of the first commercial properties in the US a year ago as part of the Slice team. But this panel is not about me, it's about my fantastic panelists. So I'd love it if you guys could introduce yourselves.
I'm Andy Singleton, and I'm the founder of Above Board Securities. My interest is really in innovation. About 20 years ago, I filled a house in New Hampshire with single-board computers to simulate evolution and how innovation actually works in the economy as a way of evolving. And I find that open source tools, which is what we've come to with blockchain and crypto, are very useful for spreading that. I'm currently working on a project called HumanDB, where we will use open source tools to create a market for apps, experts, and data to treat cancer. Everyone will have their own node where we can give them AI-based advice. I got involved in the securities industry right out of college. I worked for a guy named Ivan Boesky, who actually got thrown in jail. So I had to find a new job with some of the other guys, and I helped start a company called SNL Securities, which did pretty well. I came back to that about a year ago with Above Board, where my goal was to promote innovation through equity distribution, tokenized equity distribution. It turns out there's no demand for that, which is one of the things we're going to talk about here. And I've since moved on to figuring out how to make securities for which there is a demand, and hopefully we can talk about that.
I'm David Knowles. I am the managing director of Stanfield Partners. My whole career has been a long way from blockchain. I was a Wall Street investment banker, God help me, for most of my career. And my interest now is trying to get the real estate industry into the 21st century. And I think tokenization is one of the vehicles that our industry can hugely benefit from. It's an additional complementary, as we'll talk about later, capital market that I think the institutional real estate market should definitely take advantage of, and we're working on some things to hopefully make that happen. So it's a very exciting opportunity for me to put an old world industry like real estate together with tokenization, blockchain, and tech.
My name is Kevin Cuddeback. I'm with Invenium Capital. My background is in data and data science, particularly open data sources. If we had more time, I would tell you about HUD Form 1003. Do people know HUD Form 1003? It's a great real estate form. In the mortgage crisis, even in every no-doc loan, there was a doc, and it's HUD Form 1003. And there were three things that you had to put on that. You had to put your zip code, you had to put your job title, and you had to put your salary. I was at salary.com at that time, and half of the mortgage industry came to us and said, can you take the job title and the zip code and tell us whether it is unusual for an emergency room nurse to be making $280,000 a year, or for a truck driver to be making $140,000. In fact, there were a lot of salaries where it appeared there had just been a 1 put in front of what their actual salary was. We didn't actually get that product out in time. Most of our bought customers stopped doing that business before we were able to get that to the market. But that, for me, is a favorite story of there is key information available in the origination of securities that will come in handy later. You may not know how to use it now. My role at Invenium is to make sure that we keep that and that we mobilize it through blockchain technologies.
And for those who don't know, Invenium is in the middle of a $260 million tokenization of 4 different assets, right?
Correct.
Including...
It's not an offer to buy or sell securities.
Say again? Yes. Disclaimer, this is not an offer.
Yes.
Yeah, so...
we have the WeWork building in downtown Miami, a water pipeline in Williston, North Dakota, multifamily housing in Florida, and a student housing project in Fargo, North Dakota, which we are creating We will be the general partner in a Delaware limited partnership, and the equity in those deals will be issued as ERC20 tokens after a Dutch auction.
So thank you very much for the intros. Part of the reason that I'm so excited to speak with all three of you is because we are moving into the next generation of real estate tokenization. We've proven that the technology works, and now we're trying to figure out how do we offer these things with real, tangible, immediate benefits. We're not just saying, all right, you had a share, now you have a token, and at some future undetermined date there will be liquidity. We're trying to create an offering where people want to buy that simply because it's attractive. And each of you has very interesting ideas on how this will continue to iterate and evolve into a mature industry. And so, David, I'd like to start with a question for you. Tokenization represents one of the most significant evolutions to real estate capital markets since you were creating the public REIT market in the early 90s. How does this new iteration sort of parallel what you were doing back then, and how is it different?
Well, I think the potential for real estate tokenization is actually greater potentially than the REIT market. The REIT's a $4.5 trillion market, something like that. And tokenization, again, is a complement, not a competitive capital market, potentially to the institutional real estate market, both the private market and the public REIT market. But if you look at tokenization taken to its extreme, it's really better than the REIT market. There's better disclosure, and I understand the blockchain mechanism, record-keeping mechanism needs to be improved, and a better platform needs to be created. But ultimately, the REIT market got deficiencies that the tokenization market should improve. And when I first learned about tokenization, partly through people like Henry, I said to myself, boy, this has such incredible appeal to major real estate institutional investors and owners. And so we have actually started to talk to major REITs. When I was at Merrill Lynch, we took, I think, 30 major real estate companies public. I was the lead banker for Essex Property Trust, which is a $20 billion multifamily REIT. I took CB Commercial public. And so we're talking to these same entities today about being able to use tokenization, again, as an additional capital alternative. I think can everyone hear me still? Let me put this back on. Sorry.
That's all right. Andy, so you founded Above Board. You guys pioneered a great deal of the development of programmable securities, but you recently wrote an article about how the sort of current status of this industry is near death. It's a little bit moribund right now. And we heard that a little bit on one of the previous panels where we're trying to figure out how to bring more investors into this space. There's a lot of demand on the issuer side. There's not a lot of demand on the demand side. And so you have some very interesting thoughts about this, but I'd like to, before we even get into that, is tell me what sort of caused you to come to that prognosis. What was your experience with Above Board that brought you to that place?
Well, my experience was that although we have a lot of good reasons to offer, for instance, equity, private equity in tokenized form, we can list out these reasons: global distribution, program compliance, which is what makes the exchange easier. We can add membership features to these, some utility features to these tokens. Although we have a lot of good arguments for it, the investors really didn't want them. I mean, it was really perceived as a negative. And I think that it's an open secret now, we've heard a lot of people talk about it, that investors are not buying these tokenized securities. But I felt the need to call out that for discussion because we can't fix it until we've really focused on that problem that there's no demand. There's a lot of people selling these securities. And it's not self-fixing. It's not like a bunch of people who are trying to sell securities can get together and say, hey, let's figure out a better way to sell these crappy deals, until the buy side gets involved and says what they want, until it's demand driven, there's not the force and the impetus to push it in the right direction. So we actually ended up in that trap. And my opinion is that people are focusing on the wrong issues. They're focusing on infrastructure. If we have better infrastructure, more people will trade securities in this format, they'll buy securities in this format. That actually isn't how history and how markets work. Returns, people buy securities and buy investments because they expect excess returns. And those returns are actually inversely correlated with infrastructure. The people who made the most money on Bitcoin were people who were in gas station parking lots trading with thumb drives. I remember those days. Those guys made a lot of money. The people who had the nice Coinbase account made a lot less money. And the same thing is true if you think about early stage investing. The guy that's willing to write a check before there's even a subscription agreement is the guy that's going to make the most money on that deal. So that's the situation we're in. I think there's very real reasons that these are unattractive investments. We can talk about that. There's small caps, and there's a lot. You have to handle small caps differently if you're going to distribute them to passive investors.
And I think
there's an adverse selection.
Yeah.
These are deals that didn't sell anywhere else. There's solutions to all these issues, but we have to bring them up to the front and look at the real issue, which is it a good investment?
Yeah, absolutely. And I think that one of the things that really helps to lubricate a market like that, where there is just a flood of product that is very difficult to differentiate one from another, is data can certainly help. And so, Kevin, that's something that you guys are very focused on.
Yeah.
You're the latest and biggest and probably most interesting real estate tokenization deal to come down the pipeline. We did it with Slice. There was elevated returns with the St. Regis, Propeller, and Harbor. And now you guys have come in and you have a little bit of an interesting twist on that, adding something that I think really capitalizes on the digital nature of the blockchain. So
Yes. Well, and I'm going to say that we consider ourselves in the middle market lending, $10 million to $100 million, bigger than your local bank will do, but not worth a full-blown bond offering. And in that space, it's just crying out. There are problems crying out for technological solutions. At the NYU FinTech conference in October, basically every sentence could have had, except for middle market lending, appended to the end of it. Our problem is that debt limited partnerships go stale. People say, gee, it is a lot like the market for used cars before Carfax. If you're selling it, people assume there's something wrong with it, and you don't have a Carfax report to prove this is a perfectly good limited partnership. It just no longer meets my needs. It no longer fits in my portfolio. But everybody, instead of the value going up as the asset seasons, the value goes down as the diligence gets stale. So our goal is to make to use the blockchain as a way of validating and conveying all the hard work that went into diligencing the transaction originally and its performance over time. So we're calling that our data-rich token. It may actually be hashes and pointers out to a deal room repository. Not all of this stuff is going to be on the blockchain, but it solves this information, and it's just an information problem. These are great assets, but just like the market for used cars, where everybody assumed they had to offer the average price for the average car, and so all the good used cars never come to market. We would say there is no secondary market in these debt-limited partnerships because there is not good data, there is no Carfax, there is no way to evaluate their performance and current quality.
Yeah. So you can start to create a bifurcation between assets that are tokenized and have this real-time updated data, potentially trading at some sort of a premium to the assets that otherwise do not have that stream of data.
Right, or don't trade at all, because the reality is that these things tend to be held by family offices and insurance companies for the long time, and they just earn the income stream that comes off them, and they would never think of reselling them because they know they'll never. It's just like when you own a quality used car, you keep it in your portfolio because you know that nobody else will ever appreciate or pay a fair price for it the way you value it and using it yourself.
Yeah.
So that's where all of the best limited partnerships sit today. They sit with their owners, and the problem is on both sides of the market.
And it's interesting because when you think about it, so much of the securities markets, right? We were talking about the size of the REIT market, but when you look at public capital markets, so much of it is actually dominated by derivatives. And currently, right now, it's very difficult to figure out what is underlying a derivative that you're buying. So creating these types of data connections can add a lot of transparency into those markets, right?
Yes, and that's why I like my HUD Form 1003. If everybody in the mortgage derivative market had been able to go in and see the correlation between people's job titles and their stated salaries on their no-doc loans, the loans wouldn't have happened, the loans would have been properly valued, we would never have gotten just all the breakage in the market that we got.
Yeah. David?
Can I make a comment?
Please.
We're trying, I'm not sure if this is working or...
That was good.
The baton of power.
We're taking a totally different approach to trying to get the real estate market to use tokenization. When we created the REIT market back in the 90s, we started not with average real estate companies or average real estate assets. We went to the best real estate companies in the world, Boston Properties, all of Sam Zell's private companies at the time, and we convinced them this would be a better way to raise capital. And I think tokenization is going to take a very similar path. As I said earlier, we're talking to major REITs, and they are very enthusiastic about this. And I think they will adopt it if we have to build a market. And the way we would build a market, we have the best companies, the best assets, and we're going to go to exactly the same investors. We're going to go to investors that would buy a REIT, investors that would buy not a student housing deal with all due respect, but would buy a major Class A office building in downtown San Francisco or New York. And
we don't have anyone from Harbor on this panel, so you don't have to be too respectful. Right. By the way, I think that I don't think the ear thing is working at all, so you could probably just take that off and just
I can just take this out.
The handset.
So again, we're taking a pretty different approach. We're starting at the top of the institutional real estate market, trying to get the superior owners, the superior assets into play. And the early discussions that we've had with them already, they are game. They want this to happen. Because it would be an alternative to, if you take Boston Properties, use that example, they sell 50% joint venture interests in major office buildings all the time. This would be a way to do that, but instead of going to CalPERS and saying buy a private placement in a 50% interest in the Salesforce Tower in San Francisco, they would buy a tokenized version of that. And again, we've got great enthusiasm, but this has to, the platform is lacking at the moment in tokenized real estate. I think there has to be a dedicated platform. There's too many players, in my judgment, from what I've seen in the tokenized market. There's probably got to be a dedicated version of the New York Stock Exchange or NASDAQ, and I know NASDAQ is considered, getting involved in this new market. And I think when that happens, I think this will be really a fantastic trillion-dollar market.
Yeah. And, a lot of the stuff that you're talking about are mid to large cap deals, right? It's the bigger tokenizations, those big deals that are coming down the line. But an interesting issue is that when you go down into smaller and smaller cap deals, the liquidity is less existent, right?
Yeah, I mean, again, I'll tell you specifically what we've done. We've gone to 4 or 5 major REITs. We said, let's take a tiny piece of your portfolio. These are all $20, $30 billion market cap institutions. And we've said, let's take $250 million, $500 million, which to them, that's a large number, but in the institutional public REIT market, it's a small number. Let's take a $500 million piece, 50% of your assets. It can be fractionalized in any way. That's one of the beauties of tokenization. It can be totally fractionalized. It's more liquid ultimately, better disclosure. That's why I think it's got such great potential. And we've talked to these REITs and they said, let's do it. The problem, the platform has not been created yet, and we are having discussions with some of them. If you get some of these large owners behind this concept, it will make this market. Because these are, collectively, it's $1 trillion capital market. And you get that kind of force behind it in terms of investors, in terms of attorneys, in terms of accountants, in terms of market makers, it'll happen. So
Sure.
I think this is actually an easier version than creating the REIT market back in the 90s.
Yeah, yeah. And so if something like that were to happen, right, you would end up having a whole bunch of small deals that are all individually tokenized. And you need to figure out some way to standardize the terms of those deals to ensure that the investors in those deals, the LPs, are getting the best deal possible, true market rate returns. And so, Andy, I know that you have some thoughts about that. So I'd love to hear your concept of the unbundled fund.
Oh, well, thank you, Henry. It's something that we haven't implemented yet, but it's an idea I'd like to propose, and I'm very eager to hear, David, how you're going to approach unbundling these funds into tokens. But there's some very real problems that we have to solve, and I view it as two levels. The one problem is the small cap problem. How are passive security investors going to be represented in these small cap deals? How are they going to get the disclosure that they need, and how are they going to act on that? It's typically not built into a small cap deal. And the way that that's usually handled is you have a fund manager handle it. They buy a big piece of the deal, they're a lead investor. And we need these fund managers not only to provide that lead investor service, but we also need them to roll these small cap deals into large cap deals, because most of the money in our economy is invested in large caps. Most of 80% of it's invested with professional managers. Mm-hmm. It's not going to be crowdfunding. So we have this sort of Rubik's Cube of constraints around the new tokenized fund structure. And one thing that does not satisfy these constraints is just taking the LPs, these long-term LP interests, and selling them as securities. That hasn't worked. There's too many costs. There's uninvested fund costs, which you don't have with a capital call structure. There's sales costs. There's closed-end discounts, which you start to get because a lot of these funds are evergreen. These funds are not selling. If they do sell, you end up with a problem that a lot of them are classed as private in the U.S., and private traded securitized funds in the U.S. is just a category that can't work. You can get small VC funds that have 100 shareholders. That's literally where you are. So that's more of the Rubik's Cube. And then we layer in that in real estate, a lot of the demand is foreign investors, non-U.S. investors that want to buy U.S. real estate, and they get hit with this weird law called FIRPTA that says they have to pay this extra tax. So you need some sort of a blocker, it's called, so that they don't have to, at least even if they pay the tax, and they don't have to deal with the hassle of that. So putting this Rubik's Cube together, my proposal is what I call the unbundled fund, which is to take the fund management and attach it to the individual assets, to say we're going to have a lead investor, exactly like a syndicated venture capital deal where you have a lead investor, but then you have passive investors that come in on the same terms. We're going to provide that service for small cap deals that need to make themselves viable by passive security investors. At that point, we can go to the next phase of fixing this problem, which is we need to roll them up into large cap deals, and we can use an ETF structure, which is a very cheap, sort of an unmanaged fund structure almost, because we have the active fund management, the representation already in at the individual asset level. So that's the proposal in a nutshell. There's a lot of regulatory issues. It either has to be a public fund if it's going to come to the U.S. or be offshore. So we're going to have to start offshore with these roll-ups, come back when we're big enough. But there you go. There's going to be different ways to look at this Rubik's Cube, but those are some of the elements.
It's the Uber for asset managers, basically.
Exactly. Yeah,
you got a deal you want to get done.
There's a lot of fantastic emerging asset managers in this room that could fill this lead investor role and really make the world safe for these investments.
Yeah.
Could I ask you a question? How would that be different than just syndicating a large private placement of an institutional real estate fund? Wouldn't it be analogous?
What I'm proposing is syndicating at the single asset level, sort of the way that it's
Rather
done at
than
a
in a
VC level.
portfolio.
Yeah, because what we're trying to do is we're trying to mix in the benefits of this tokenized liquidity. So, for example, the fund would probably be closed-end coming in. You wouldn't be able to create, like an ETF, you wouldn't be able to create new shares anytime you want. You'd have to underwrite and price when you swap shares in. But it could be open-ended going out. We could make it redeemable so you never were stuck with a closed-end discount. We could even try to get a ratchet where it could trade above NAV but not below, things like that.
See, the reason I think that's attractive to the institutional real estate investment community, it's more liquid, and it could be fractionalized in any amount you want. That's why I think the potential is so huge.
Yeah, so we know that liquidity doesn't always develop. Liquidity is a feature of what your shareholders want to do in buying and selling, right? It's not a feature of the security, but at least this way we have a lot of flexibility. We have a large cap fund that we know is going to be a liquid asset. It's got enough shareholders. It's traded, it may be even offered through exchanges. I think that's a good venue for these international offerings. But we also have this opportunity to redeem out into the individual small cap securities. That helps us do things like, well, if we're going to start to realize a profit, maybe we can redeem it out to U.S. investors. And those are ways of handling things like FERPTA. So it gives you a toolkit that you didn't have before tokenized securities.
Yeah. And Kevin, you guys are also approaching this issue from an interesting angle as well. You guys are doing a Dutch auction for your raise.
Right.
So I'd love to hear, that's the first time we've seen that in a security token offering. I'd love to hear what sort of, drove you guys to implement that specific feature.
I think to us, we are looking towards a future of a real market clearing price. Too much of our kind of lending is really just both sides staring each other down. There's no there's no information exchanged in the process.
Capital market standoff.
So yes, what we're proposing is a Dutch auction to set the market clearing price in the limited partnerships in these deals.
Got it. And so from your guys' perspective, you guys have a long history in the bond and debt markets. And I know that some of this offer, I think, is structured as debt. Is that correct?
That's correct. So the WeWork building in Miami is equity, and the other three are a debt. They are all limited partnerships.
And so did a debt structure lend itself better to this sort of debt auction, Dutch auction mechanism?
I'll get back to you after we do the WeWork building, the equity one.
Got it.
Doing that one first.
Got it. David, you have been very deep in the real estate tech world as well, ever since you reformed from your investment banking days. And you work with a lot of prop tech firms, AI, smart buildings, all of this. So the type of data-enabled infrastructure that Invenium is building, is that something that can start plugging into these smart buildings and AI, machine learning?
Oh, absolutely. It's just another version of, the real estate industry, which is the largest capital market asset class in the world, $220 trillion. It's the most backward industry at the same time. And as more data becomes readily available and disclosed, real estate is the only industry in the world you make money by hiding information rather than disclosing information historically. But smart buildings, AI, I'm moderating a panel next week in Nashville at the Urban Land Institute on artificial intelligence. And it's definitely going to be part of the equation, smart buildings, AI, construction technology. Construction is probably the most inefficient part of the whole real estate industry, and construction is totally a great candidate for improvement and efficiency.
Absolutely.
Facilitated by by data.
Yes. And also, it seems like construction, a lot of it is almost very similar to supply chain management. And so I don't know if you've seen on your end anyone using blockchain technologies to apply to the construction process, because like you said, it's an absolute nightmare.
It's starting to converge. Katera, everyone probably knows, is a $3 billion plus private real estate startup. It's only 4 years old, I think. They are starting to consider using blockchain.
Interesting. It's good to see that there's a lot of, both on the established side with the REITs, and then also the more established tech players are starting to look at this. And I guess, this is sort of a question for the panel in general, is, each of you has a deep, both institutional background and tech background. Kevin, you've been in data sciences for a long time. David, you've been in securities for ages, and, you've created 20 plus software programs and written, I think it's 1 million lines of code, right? And we're in AI 20 years ago. So how are you guys, how is that conversation starting to change with those more entrenched players as it pertains to blockchain? 6 months ago, it seemed like a lot of people had trouble getting past the idea that blockchain was linked to cryptocurrencies, Bitcoin, ICOs. Has that conversation started to change in a lot of these, outside of your companies, because obviously each of you is deeply invested in the blockchain, but in your contacts outside of there, how's that conversation starting to change?
My feeling is that large companies have to go after large markets. That's why there's room for small companies and startups. That's a good thing for the small companies, and they're going to gravitate to this asset class when it's big.
Yeah.
And they've crypto at 100 billion has gotten there, right? Crypto securities just aren't there yet. And one of the things that you're going to see is that when we talk about blockchain as opposed to crypto securities, that big companies can get away with much smaller slices of value, like fixing the settlement process over at DTCC. They have a blockchain project for that. The process of settling securities trades is already amazingly sufficient. They settle $100 trillion worth of trades at DTCC on a $2 billion a year budget, but it's always something, right? Once you start working at that scale, if you take out 100 million here and 100 million there.
Middle market lending has plenty of inefficiencies that that we can work on. It's a big budget in terms of just the amount of value that's currently taken by middlemen in all these transactions.
But I think value creation with the asset-backed securities that are transparent, that could be huge, right? That's value creation as opposed to just efficiency. It's new.
Blockchain is the ultimate record-keeping mechanism. And real estate information and data is very simple, but it's voluminous. And if real estate can't take advantage of blockchain, I don't know what industry can.
We're thinking, though, that things like equipment trusts, so we've done 8 different deals. They've not all been real estate. One of them was a pool of used rail cars. Mm-hmm. And we didn't do this here, but you could imagine, you say, these must stay in the United States. And if we put a GPS pinger on them, then we can be enforcing the deal covenants electronically and conveying that back. But you'll see that in oil services vessels, drilling rigs, tankers, just any of those movable assets. Mm-hmm. I think we will see that first because people know the value of GPS. They know the value of key. You don't have the problem that real estate wanders from jurisdiction to jurisdiction.
You shouldn't. So you guys actually brought up an interesting point about how blockchain is offering incremental benefits. And in the tech world, there's a saying that basically if your innovation is not 10 times better than whatever existed before, then it's not going to succeed. It's not going to change the paradigm. Is that possible in real estate? And is that really just the wrong way of looking at it? Are these incremental benefits really enough to push this stagnant dinosaur of an industry into the arms of blockchain?
on behalf of the stagnant dinosaur and on behalf of the least efficient. I mean, like, if we had all those Class A buildings, in other words, their value is easily understood. We've made our living in kind of the hairy, messy, ugly. It's very easy to get financing for new rail cars. Getting financing on used rail cars, that's the kind of deals that we've been doing. And with family companies who have never had a public accountant in there, the first financial statements, that really snapped a grid. So we have all the pain points that blockchain is solving. I mean, I'm not going to speculate on how it can solve everybody else's problems, but for these middle market sized loans to family companies, private companies, the middle of the market, it's such a mess. And all the stuff around record keeping and keeping the diligence fresh is the constant challenge there for lenders.
I think there's really two different approaches to tokenized securities and to real estate. One approach is we have to create new products and create new value. It's sort of hard to see how that works with real estate in a situation where real estate is making you 6 or 7% a year. It may be that real estate is in the category that we're adding efficiency. We can take out a small slice. We can take out 50 basis points somewhere with efficiency. And in that case, we have to do this at huge volume. That's an option with real estate because it's such a huge industry and so diverse. There's room for everybody. I know that in your notes you said, is Blackstone going to take this over? Well, no, they have a tiny market share. But I think we do need to think differently about those two paths. Isn't a new product? Nobody's going to buy a new product unless it's really a lot better. It's too hard to think about, too hard to figure out. We made the mistake of trying to sell tokenized securities, like the student housing wasn't better at all, right? Nobody's going to deal with that. But if it's not a new product, if it's just something that's in the old product, yeah, we can get away with those thin slices of value. So we're following both tracks, but they're different.
Yeah.
The real estate tech industry is about 6, 7 years old at most. And in that period of time, the global real estate markets have generally improved. And it has not been compelling to be absolutely efficient. I think if we see a market downturn where lease rates start to decline, occupancy declines, and there's more pressure on owners, I think that'll actually accelerate the use of things like blockchain and all forms of real estate tech, because you'll have to do it to make money.
Mm-hmm. It's such a thin margin business in general. If you can offer a 50 basis point improvement in operations or the returns of the deal, extrapolate that across a few $1 trillion worth of assets, and you start to see some massive value creation there, right?
Yeah, I mean, the reason real estate is an attractive profession for people to enter into it, it's the most inefficient large capital market in the world. And blockchain is the opposite of that. It's the most efficient mechanism. So I think there will be a convergence, but we probably have to move into poorer markets to make that happen.
Interesting. So the blockchain industry sort of came with this dream of creating a new financial paradigm where we have new stakeholders, new participants, and we get to assail the position of these, formerly unassailable incumbents, right? The Goldman Sachs and the BlackRocks of the space. As we get further into it, and it seems like these may be process efficiencies and evolutions more than potentially massive revolutions, are we going to see them get disintermediated? Are we going to see them no longer, be the monoliths in those industries, or are we just going to see them end up, buying up the promising blockchain startups and continuing to dominate these capital markets?
I don't think they dominate. Real estate is so big, right?
Yeah.
It's so big and diverse. But definitely the opportunity is still there for startups, whether they get bought later or not,
Yeah.
to get into this business. But startups should be in the new product business. new kinds of new global distribution, bringing new people in, it's going to be hard if they're going to, all of those companies that you talked about are partners in this DTCC effort to use blockchain to sort of grind down costs.
And so I guess
that's for them, and this is for us.
Right. And so the question is, are we going to develop a parallel capital market infrastructure here?
Yes. That's probably what's going to happen. That we're in a disruptive phase right now with the securities industry where we have a product that's actually not good enough to replace the public markets. So where the disruption is with the public markets. We have a product that's not good enough, and that's the classic Clayton Christensen theory of disruption. It's being used by people who don't have access to the public markets. Weird private deals, those are the things we're looking for. New deals that couldn't get done. But once the infrastructure thing starts to become relevant, what are people saying 4 or 5 years from now when it starts to become clear that, well, this is just better. And why is it better? Because it's simpler, right? There's huge stacks of infrastructure in the public markets. Mainframe, talking to mainframe, talking to mainframe. There's no way you can innovate in that system. You can't change one piece of it without changing all of it. And to go from T3 to T2 settlement is a 5-year process, whereas it just comes naturally with blockchain. So we've compressed all that stuff out. But the disruptive effect doesn't hit in until the early adopters have really gotten to a certain point.
For us, we would be just happy to put the telephone out of business in our segment of it. I mean, that is the cutting edge technology, Mr. Bell's invention, is how our kind of banking gets done. And the idea that it might actually happen with an electronic overlay of knowledge about what people like, what they're in the market for. We think, at least for our kind of stuff, the market making is going to look more like online dating. Established Swiss family office seeks leisure-oriented property, must be non-smoker, must love pets. And then another hand will go up, Cancun real estate, Cancun resort, non-smoking, loves pets, and we're going to see that. That little transaction happen that you just wouldn't do today because, again, nobody resells these things because even as much as they love them, they just know that no one else will give them a fair price for them.
Yeah. David, some closing thoughts here?
Well, I think the one thing that needs to happen in the real estate tech industry is we need to have entrance from outside of real estate. The culture of real estate, again, is so backward relative to other industries, and putting tech and real estate together is almost a non-starter. And I think what could really help real estate if one day an Oracle or a Microsoft or one of the behemoths outside of real estate said, like, for example, some of the programming languages and property management systems in real estate are so archaic. People in this room and elsewhere can look at some, I won't mention any names, but they are so backward. They should just be trashed and started over by somebody from outside, an Oracle or whomever, that really understands the way data can be processed and managed.
Yeah.
So I think the best thing that happened to real estate is to have somebody from, again, outside enter this gigantic industry, and I think it will happen. But
So there is scope for a revolutionary upset.
we've only been at this for 5 years, but give us a few more, and I think.
And only one for real estate tokenization. So, and only 1 year for real estate tokenization. So, well, thank you, all three of you, for your fantastic insights. That was amazing. Thank you.